Hi everyone, today we'll be going over accounts, May-June 2021, paper 3-1, question number 6. This is structure paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 6 is a part of section B, which relates to cost and management accounting. Now, without any further delay, let's get started. The directors of W Limited plan to buy a new machine costing 220,000 for making a new product. So this will be our initial investment. And the machine will have a useful life of 4 years with no scrap value. Okay, so meaning that the scrap value is actually 0 and the number of useful life is 4 years. Okay, now we are given the cash inflows and cash outflows from the new product for 4 years. And we are given that the cost of capital is 8%, meaning that this is the interest rate that we will use to figure out our discount factor and adjust the time value of money by figuring out the net present value. Okay. Now for the first part of this question, we need to calculate the accounting rate of return ARR. Let's do that. Now what we know is that the accounting rate of return is just the average profit divided by the average investment times 100%. So in order to figure out our accounting rate of return, we first need to figure out our average profit and the average investment. So we can easily figure out the average investment. This is just going to be the initial investment divided by 2. Let's have a look at the above information for our initial investment. That was 220,000. So let's figure out our average investment. That is just going to be 220,000 divided by 2, which results in 110,000. Now, in order to figure out the average profit, we first need to figure out our profit for the year 1, 2, 3, and 4. And we are already given the cash inflows and cash outflows, but since we're figuring out the profit, we also need to adjust our non-cash expense, which is that of depreciation. So let's figure out the depreciation machinery for each year. And we are given that the machinery will have a useful life of 4 years with no scrap value, meaning that we will be charging our depreciation on a straight line basis. So on a straight line basis, that's just going to be the initial investment minus scrap value divided by the number of useful life. We know that our initial investment is 220,000. We know that the scrap value is 0 divided by 4. So this gives our depreciation for each year to be 55,000. We also need to adjust our depreciation to the net cash flow in order to figure out the profits for the year 1, 2, 3, and 4. Let's list down our inflows and outflows. So the inflows for year 1, 2, 3, and 4 are 100,000, 132,000, 160,000, and 92,000 respectively. Let's list that down. So we have the year 1, 2, 3, and 4. We have our inflows. For year 1, that was 100,000. For year 2, it was 132,000. For year 3, it was 160,000. And for year 4, that was 92,000. Now we also need to list our outflow. Let's have a look at the above information. So the outflows for year 1, 2, 3, and 4 are 36,000, 50,000, 68,000, and 50,000 respectively. Let's write it down. For the first year, the outflow was 36,000. For the second year, it is 50,000. For the third year, it is 68,000. And for the final year, it is 50,000 again. Now we also need to subtract the depreciation charge for each year. Let's have a look above. We already figured out our depreciation charge for each year to be 55,000. So let's write it down. That's 55,000. 55,000, 55,000, and again 55,000. Now we can easily figure out our profit for these 4 years. And the profit is just going to be the inflows minus outflows minus depreciation. So for the first year, that's going to be 100,000 minus 36,000 minus 55,000, which results in the profit for the first year to be 9,000. Similarly, for second year, that's going to be 132,000 minus 50,000 minus 55,000, which results in the profit for second year to be 27,000. Now for the third year, that's 160,000 minus 68,000 minus 55,000, which results in the profit for third year to be 37,000. And for the last year, that's going to be 92,000 minus 50,000 minus 55,000, which results in the negative balance of 13,000, which means that there is 13,000 loss for the fourth year. Now we figure out our total profit for the 4 years. That's just going to be the sum of these 4 amounts. So that's 9,000 plus 27,000 plus 37,000 minus 13,000, which results in 60,000. So that's the total profit for 4 years. Now we need to figure out our average profit. So average profit is just going to be the total profit divided by the number of years. In this case, that's going to be 60,000 divided by 4, which results in the average profit to be 15,000. Now we just substitute these two values into our formula for the accounting rate of return. So we have our average profit of 15,000 divided by our average investment of 110,000 times 100%. So the accounting rate of return is going to be 15,000 divided by 110,000 times 100%, which results in 13.64%. This concludes the first part. Now we can move to the second part. For the second part, we are required to figure out the net present value. For net present value, we just need to record our inflows and outflows and then figure out the net cash flow and multiply it with the discounting factor in order to figure out our net present value for each year. Then we just add those net present values in order to figure out the total net present value. Okay, so that's the year. We start with 0, 1, 2, 3, and 4. Then we list our inflows and our outflows. Then we figure out our net inflows, and then we multiply it with the discounting factor in order to figure out the net present value. Okay, we already recorded the inflows and outflows above, so we can just copy those amounts. So the inflows is just 100,000, 132,000, 160,000, and 92,000. Let's write it down. No inflow in year 0, and for the first year it was 100,000. For a second it was 132. For a third, it's 160, and for the last, it's 92. Now, the outflow for the year 0 is just going to be the initial investment, so that's 220,000. Now, let's have a look at the outflow information above. So, the outflows for year 1, 2, 3, and 4 is 36,000, 50,000, 68,000, and 50,000 respectively. Let's write it down. That's 36,000, 50,000, 68,000, and 50,000 again. Okay, now in order to figure out the net flow, that's just going to be inflows minus outflows. For year 0, that's 0 minus 220,000, which results in the negative balance of 220,000. For year 1, that's 100,000 minus 36,000, which results in 64,000. For year 2, that's 132,000 minus 50,000, which results in the net value to be 82,000. For year 3, that's 160,000 minus 68,000, which results in the net value to be 92,000. And for year 4, that's going to be 92,000 minus 50,000, which results in the net value to be 42,000. Now we just need to list our discounting factor for the cost of capital. Let's have a look above. We are given our cost of capital to be 8,000, so the discounting factor we use is going to be of this column. For year 1, that's 0.926. For year 2, that's 0.857. For year 3, that's 0.794. And for year 4, that's 0.735. We need to record these 4 values in our solution. So let's write it down. The discounting factor for year 1 was 0.926. For year 2, 0.857. For year 3, 0.794. And for year 4, that's 0.735. And the discounting factor for year 0 is always going to be 1 no matter the cost of capital. This is the case because we do not have to discount the amount for year 0 to year 0, right? So that's just the present value. But in case of year 1, we have to discount it using the certain factor, which is going to be 0.926. But for discounting from the same time to the same time, there does not need to be any factor. So the factor is just going to be 1. Okay, now we can move towards finding our net present value for each year. And the net present value is just going to be the net value times the discounting factor. So for year 1, that's going to be negative 220,000 times 1, which results in negative 220,000. For year 1, that's going to be 64,000 times 0.926, which results in 59,264. For year 2, that's 82,000 times 0.857, which results in 70,274. For year 3, that's 92,000 times 0.794, which results in 73,048. And for year 4, that's 42,000 times 0.735, which results in 30,870. So these are the net present value for each year. We now need to figure out the total net present value, which means that we need to add the net present value for each year. That's going to be the sum of these 5 amounts. So that's negative 220,000 plus 59,264 plus 70,274 plus 73,048 plus 30,870, which results in the net present value to be 13,456. This concludes the second part. Now we can move to the third one. We need to figure out the internal rate of return. Okay, so the internal rate of return, the formula is the lower discounting rate plus net present value at lower discounting rate divided by net present value at lower discounting rate minus net present value at higher discounting rate times higher discount rate minus lower discount rate. Okay, so let's look at the above information. We can see that we are given the discount factors for 2 discount rates. So the first one is 8% and second one is 12%, meaning that the lower discounting rate is going to be 8% and the higher discounting rate is going to be 12%. All right, let's substitute these values. So the lower one is 8% plus we require net present value at the lower discount rate, which means that we require the net present value at 8%, which we just figured out above, and that amounted to 13,456. Let's write it down. 13,456 divided by net present value at lower discount rate, which is again the same thing. So that's 13,456 minus we require net present value at a higher discount rate, meaning that we also have to figure out the net present value at the cost of capital of 12%. Okay, we will do that in a while. Then we multiply it with the higher discount rate, which is of 12%, minus the lower discount rate, which is the 8%. Now we have to figure out our net present value at 12% as well. So for that, we will start with our years. So that's 0, 1, 2, 3, and 4. And we can start with the net value because we already figured out the net cash flow in the above part. Let's have a look there. So the net cash flows for the year 0, 1, 2, and 3, 4 are negative 220,000, 64,000, 82,000, 92,000, and 42,000 respectively. Let's write it down. So for year 0, that's negative 220,000. For year 1, that's 64,000. For year 2, it's 82,000. For year 3, it's 92,000. And for year 4, it was 42,000. Now we just need to multiply it with the discounting factor. And the discounting factor we use will be that of 12%. So let's have a look at the given information. So we can see that the discount factors for the year 1, 2, 3, and 4 are 0.893, 0.797, 0.712, and 0.636 respectively. Let's write it down. For year 1, we had the discounting factor to be 0.893. For year 2, it was 0.797. For year 3, it was 0.712. And for year 4, it was 0.636. And for year 0, like I said before, no matter the rate, that's just going to be 1. Now we can move towards figuring out the net present value, which is going to be net value times the discount factor. So for year 0, that's going to be negative 220,000 times 1, which results in negative 220,000. For year 1, that's 64,000 times 0.893, which results in 57,152. For year 2, that's 82,000 times 0.797, which results in 65,354. For year 3, that's 92,000 times 0.712, which results in 65,504. For year 4, that's 42,000 times 0.636, which results in 26,712. Now we need to figure out the total net present value, which is the sum of these 5 amounts. So that's negative 220,000 plus 57,152 plus 65,354 plus 65,504 plus 26,712, which results in the negative value of 5,278. Okay, so now we need to substitute this value in our formula. So the formula is minus net present value at higher discount rate, which is 12%. And in this case, the value is in a negative. So two negatives make up a positive, so that's a plus. And the value for the net present value was 5,278. So our internal rate of return is going to be 8 plus 13,456 divided by 13,456 plus 5,278 times 12 minus 8, which results in the value of 10.87%. So this concludes the third part of this question. Now we can move to the next one. For the second part, we need to advise the directors whether or not they should buy the new machine. And we also need to justify our answer. So we will justify on the basis of what we calculated in the first part. So let's have a look. For the first one, we calculated the accounting rate of return and we figured it out to be 13.64%. We know that our cost of capital is 8%, and to have an accounting rate of return higher than the cost of capital is a good thing. So let's write it down. We can say that our accounting rate of return is higher than the cost of capital. Let's look at the second part. For the second part of this question, we figured out our net present value. And we can see that the net present value is a positive amount. So that's a good thing. Let's write it down. We can see that the net present value is positive. And for the third part, we figured out the internal rate of return. And we can see that the internal rate of return is 10.87, which is again higher than the cost of capital of 8%, which is a good thing. Let's write it down. Internal rate of return is higher than the cost of capital. So we can see that all three measures, accounting rate of return, net present value, and internal rate of return, sides with the positive factor, right? So we can advise the directors to buy the new machine. Let's write the decision clearly. The directors should buy the new machine. Okay, this concludes the second part. Now we can move to the third one. We are given additional information. The directors are of the view that net present value method should be used to make decisions on investment. Now we need to state 3 advantages of using the net present value method. The very first one is that the net present value method considers time value of money because we are incorporating the discount factors in order to bring the cash flows to their present value. So that's a major advantage. Let's write it down. It considers the time value of money. Secondly, net present value method also considers all the cash inflows and outflows over the investment's lifetime, because like we can see above, for the net present value, we incorporated the inflows, outflows, and then we figured out our net cash flow and then discounted it in order to incorporate the time value of money factor in order to figure out the net present value. So that's advantage as well. Let's write it down. It considers all cash inflows and outflows over the investment's lifetime. And lastly, cash flows are more objective than accounting profits, right? Because profit is not always equal to cash flows, and there can be a higher profit in a company, but then there can be a deteriorating condition of the cash flows. So cash flows are the more accurate method to determine whether the condition of any company or any particular asset is right or not. Let's write it down. Cash flows are more objective than accounting profits. And due to this very reason, net present value method is more accurate than the accounting rate of return, because in case of accounting rate of return, we incorporate the accounting profits rather than the cash flows. This concludes the third part of this question. Now we can move to the fourth one. We are given additional information. Due to a change in economic conditions, the directors consider that the cost of capital should be 12%. Now we need to explain the effect on the director's decision on investment of the change in the cost of capital. So we can see that when there was the cost of capital of 8%, the net present value was 13,456. But if we change our cost of capital to 12%, then that gets us the net present value of a negative amount 5,278. So let's write it down. Net present value at 12% is negative 5,278. And we can tell that if there is a negative net present value, then that investment is not worth investing in. So now the new machine should not be bought by the directors. Let's write it down. So the new machine should not be bought. This concludes the fourth part of this question. Now we can move to the fifth one. We are again given additional information. The directors also consider that the negative impact from the increase of cost of capital can be offset by increasing the revenue. This means that the negative value of the net present value can be corrected by increasing the revenue. And additional advertising costing 20,000 incurred in year 1 can help increase the sales revenue in years 2 and 3. Year 2 sales revenue is expected to increase by 24,000. So this is the income, whereas the advertising cost of 20,000 is actually an expense for the first year. Okay, now we need to calculate the minimum increase in sales revenue in year 3 to justify the directors deciding to buy the new machine. So what this question says is that we now require our new net present value to be that of 0, because we need to tilt our net present value from a negative amount to a positive amount, and 0 is better than a negative amount, right? And in order to do so, we can start with our original net present value at 12%, and that we just figured out above to be negative 5,278. Let's start with this amount. That's 5,278. Okay, and we also need to incorporate the discounting factor at 12%. Okay, let's first list down our increased values. So that is original net present value, and we know that there is an additional advertising costing 20,000 incurred in year 1. So that's an increased value for year 1, right? So advertisement, this is year 1, this resulted in 20,000. And since this is an expense, we will record this in a bracket. And we are also told that the year 2 sales revenue is expected to increase by 24,000. So this is an additional increment for year 2. Sales year 2, that's 24,000. And since this is an income, this should be recorded as a positive amount. Similarly, there is also to be increment in sales for year 3. And we actually need to figure this amount. Okay, since this is year 1, year 2, and year 3, the discount factors that we need to list are of those particular years. Let's have a look at the above information. Okay, we have it right here. The discount factor for years 1, 2, and 3 are 0.893, 0.797, and 0.712 respectively. Let's write it down. Okay, that's 0.893, 0.797, 0.712. And the next condition we have is that we require the total net present value to be 0. Okay, so let's figure out the adjustments to the net present value. For advertisement, that's negative 20,000 times 0.893, which results in negative 17,860. Then for the sales, that's 24,000 times 0.797, which results in a positive 19,128. Now we also need to figure this value out, right? So let's term it as x. Now we can write this down as an equation. So that's negative 5,278, negative 17,860, plus 19,128 plus x to be 0. X is just going to be 5,278 plus 17,860 minus 19,128, and this gives the value of x to be 4,010. So this is the particular value. Now we need to figure out this value. Let's term it as y. So what we know is that y times the discount factor is 0.712 results in the value of 4,010, right? So the y is just going to be 4,010 divided by 0.712, which gives the value of y to be 5,632. So the sales increment for year 3 is just going to be 5,632. Let's write down our answer clearly. So minimum increase in sales revenue of 5,632, which we just figured out, in year 3 will achieve just a positive net present value. Alright, so this concludes the 5th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.